What if I told you one of India's most profitable companies earns over 96% of its revenue from a product under increasing global scrutiny, cigarettes? And yet, it's a business that runs fully integrated, cash-rich, and operationally bulletproof, powering iconic brands like Marlboro, Foursquare, and Red and White to leadership positions. But here's the twist. Despite several attempts to diversify, it's still stuck inside its own success. This is the paradox of Godfrey Phillips India Ltd, a company with deep brand moats and global partnerships, now facing the biggest challenge of its next chapter. How do you grow when your core product is also your biggest risk? Welcome to the deep dive into the business model, numbers, risks, and future of one of India's most fascinating consumer companies. Godfrey Phillips India Ltd, or GPIL, is a legacy business. Founded in 1936, and today it is one of India's largest cigarette manufacturers. It's part of the KK Modi Group, and its core strength lies in a deeply integrated tobacco business, from sourcing and leaf processing to packaging and distribution. Over the years, GPIL has built a strong product lineup with flagship brands like Foursquare, Red and White, Cavender's, and the global premium brand Marlboro, which it manufactures and distributes under an exclusive license from Philip Morris International. As of Q1 FY 2025, the company generated Rs 186 crore in gross sales. But here's the important part. 96% of that revenue still comes from cigarettes. GPIL has made selective diversification efforts, such as confectionery products like Fundagoli, Pan Masala under the Panvilas brand, and third-party distribution partnerships such as with Ferrero India. However, these non-tobacco businesses are still small, and one major attempt, the 24/7 retail chain, was shut down in May 2024 due to poor scalability. So how does this business model look to investors? At its core, GPIL is a cash-generating machine. Its operations are vertically integrated, its brands enjoy pricing power, and its distribution network is deeply entrenched, especially in North India. The partnership with Philip Morris gives it a premium global brand, Marlboro, which helps it stand out from domestic competitors. But the flip side is important too. With over 96% of revenue still from tobacco, the company is exposed to rising taxes on cigarettes, stricter health regulations, and growing investor scrutiny under ESG, environmental, social, and governance norms. In simple terms, Godfrey Phillips has mastered the tobacco business, but its future depends on whether it can scale the non-tobacco segments. So far, that journey has been cautious and not yet transformative. Over the past 10 years, Godfrey Phillips India Ltd has quietly transformed itself from a low-growth, modest-margin company into a high-margin, fast-compounding business that stands out in the Indian consumer sector. Let's break down the key financial journey from FY 2016 to FY 2025 across 6 critical metrics: sales, operating profit, margins, EBITDA, net profit, and net profit margins. First, sales revenue. In FY 2016, the company reported sales of Rs 331 crore. By FY 2025, sales more than doubled to Rs 611 crore. Growth was moderate until FY 2021. But post that, GPIL entered a strong growth phase, driven by premium brands like Marlboro, growing exports, and better distribution. Second, operating profit. This is the profit from GPIL's main business, before taxes or interest. It grew from Rs 324 crore in FY 2016 to Rs 177 crore in FY 2025. That's a 14% CAGR, showing stronger operational efficiency over time. Third, operating profit margin, OPM. This tells us how much of each Rs 100 in sales GPIL keeps before taxes. Margins improved from 14% in FY 16 to 21% in FY 25, with a peak of 24% in FY 22. A margin above 20% consistently shows pricing power and excellent cost control. Fourth, EBITDA, earnings before interest, tax, depreciation, and amortization. EBITDA grew from Rs 361 crore in FY 16 to Rs 526 crore in FY 25. This includes other income and confirms multiple income streams and good capital deployment. Fifth, net profit after tax PAT. PAT rose from Rs 170 crore to Rs 1072 crore in this period, a massive 6x increase. This shows that GPIL didn't just grow sales, it converted that growth into solid bottom-line earnings. Sixth, net profit margin, NPM. NPM jumped from 7% in FY16 to 19-20% in FY24-FY25. In a consumer products company, that's exceptional and reflects brand strength, loyal customers, and tight control on expenses. In summary, GPIL's financials tell a story of profitable transformation, especially after FY 2021. The company now enjoys higher sales, higher margins, and significantly higher profits, all while staying capital efficient. Profitability means little unless it turns into real cash. That's where cash flow analysis comes in. And for investors, it's the ultimate test of whether a company can fund its growth without taking on debt. Let's break down the cash flow journey of Godfrey Phillips India Ltd across the last 10 years. From FY 2016 to FY 2025 first, cash flow from operations, CFO. This is the cash the business generates from its daily activities, like selling cigarettes, collecting payments, and managing expenses. GPIL has had positive CFO every single year, a strong sign of a self-sustaining business. In fact, the company generated Rs 736 crore in FY23 alone, its highest ever. Second, capital expenditure, CAPEX. This is the money spent to upgrade factories, buy equipment, or expand operations. GPIL's CAPEX peaked in FY 2020 at Rs 479 crore, but reduced sharply after that. By FY25, it even turned negative, Rs 25 crore, likely due to asset sales or investment reversals. Third, free cash flow, FCF. This is CFO minus CAPEX, the actual cash left after running and reinvesting in the business. GPIL had positive free cash flow in 9 out of 10 years, except FY20. FY23 was especially strong, with Rs 653 crore in FCF. Fourth, cash from investing, CFI. This includes buying or selling assets and investments. GPIL had negative CFI in most years, a sign that it's reinvesting into the business. However, FY24 and FY25 show positive CFI, likely due to asset sales or investment redemptions. Fifth, cash from financing, CFF. This shows how much cash went to shareholders or debt repayments. CFF has been consistently negative, meaning GPIL regularly repays debt and pays dividends. It does not rely on outside money to grow. Sixth, net cash flow. This is the overall cash change each year. GPIL's net cash flow remains stable to slightly negative because most cash gets deployed productively. It doesn't sit idle. Finally, cash balance at year-end. GPIL maintained a steady cash balance between Rs 25 Rs 50 crore, enough for day-to-day needs but not excessive. So what does all this tell us? GPIL is a cash-efficient, financially disciplined company. It funds growth from within, avoids debt, and creates surplus cash, a rare trait even among profitable businesses. Strong cash flow is only half the picture. As investors, we must also ask, how wisely is that cash being used? In this section, we look at whether Godfrey Phillips India Ltd is not just profitable, but also efficient at creating shareholder value through capital allocation. And here's what the numbers say. First, return on capital employed, ROCE. This tells us how efficiently the company uses all the capital in the business. GPIL's ROCE rose from just 9% in FY16 to 22% in FY25. This is a major positive. Anything above 15% is considered capital efficient. Second, return on equity, ROE. This tells us how well the company uses shareholders' money. GPIL's ROE improved from 8% in FY16 to 23% in FY25, showing that retained profits are being productively reinvested. Third, cumulative PAT and CFO. Over 10 years, GPIL earned Rs 571 crore in profit after tax, PAT, and generated Rs 739 crore in operating cash flow. That means around 82% of accounting profits were converted to real cash, which proves the company's earnings quality is high and reliable. Fourth, retained earnings. Out of total profits, GPIL retained Rs 178 crore over the decade. This is the amount reinvested into the business. Finally, market cap value creation. Here's the most eye-opening number. GPIL added Rs 159 crore in market value between FY16 and FY25. This means that for every Rs 1 it retained in earnings, it created Rs 12 in investor wealth. That's a 12x value creation ratio, a rare achievement even among top-performing companies. In short, Godfrey Phillips India is not just profitable. It is a disciplined, high ROCE, value-generating machine. The company doesn't chase growth for the sake of it. Instead, it carefully reinvests only where returns are proven, which leads to consistent compounding. As investors, we often ask, how fast can a company grow without borrowing money or issuing new shares? The answer lies in a powerful yet often ignored metric: self-sustainable growth rate, or SSGR. It tells us, if the company reinvests all its profits, how much can it grow sales on its own, without depending on banks or the stock market? So what does the SSGR trend tell us about Godfrey Phillips India Ltd? In FY 2019, GPIL's SSGR was just 6%. That means it could only grow sales by 6% per year using its internal profits. But by FY 2025, the number skyrocketed to 52%. Let that sink in. The company can now grow over 50% per year purely from its own earnings if reinvested fully. In between, the improvement has been steady and consistent. FY 20, 12%, FY 21, 16%, FY 22, 14%, FY 23, 18%, FY 24, 31%, FY 25, 52%. What's driving this growth? Rising RO. The company is earning more per Rs 1 of equity, high retention ratio. Most profits are being reinvested. So what does this mean for investors? It means Godfrey Phillips is financially self-reliant. Its actual sales growth today, around 20%, is much lower than its SSGR, which gives it ample cash surplus, flexibility for dividends, and freedom from external debt. Most companies grow faster than their SSGR and get into trouble. GPIL is doing the opposite. It's growing sustainably and still generating more cash than it needs. That's a sign of financial strength, internal discipline, and true scalability. Profitability isn't just about sales or margins. A truly great business also runs lean and efficient, using its factories, people, and money wisely. In this scene, we explore Godfrey Phillips India's operational efficiency through key cost metrics, asset usage, and working capital behavior. First, net fixed asset turnover. This tells us how much revenue is generated from each rupee invested in factories, equipment, and plants. GPIL's asset turnover improved dramatically, from just 3.45 in FY17 to 6.91 in FY25. That means the same assets are being used to generate 70x more revenue, a major sign of operational leverage. Second, operating profit margin, OPM. OPM rose from 14% in FY16 to 24% in FY22 and then stabilized around 21% in FY24-FY25. This reflects both cost control and pricing power. Third, cost structure breakdown. Let's look at key cost heads. As a percentage of sales, raw material costs rose from 45% to 58% in FY25. Employee costs dropped from 11% to just 7%. Selling and admin, S&A, declined sharply from 22% to 9%. These numbers tell us two things. GPIL has scaled up without inflating overheads, but raw material inflation is now pressuring margins. Fourth, other expenses. There's a sudden spike in other expenses to 14% in FY25, far above the historical range of 15%. This needs monitoring. It could be one-time charges or signs of structural cost increases, such as retail losses or legal charges. Fifth, working capital cycle. As of FY25, GPIL has a working capital cycle of approximately 104 days, up from 83 days earlier in FY16. This rise is mainly due to inventory buildup, possibly in retail or pan masala segments. While manageable today, it means more cash is tied up and efficiency must be watched. So what's the bottom line? Godfrey Phillips has done a stellar job of scaling up operations without bloating costs. Its factories are running near full capacity, and fixed assets are highly productive. But rising raw material costs, other expenses and growing inventory need careful tracking going forward. When evaluating any business, knowing who controls it is key. In the case of Godfrey Phillips India Ltd, promoter ownership is both high and stable. As per the report, the promoters, the KK Modi Group, hold 72.58% of the company, and this figure has remained unchanged over the last 3 years. Why this matters? A high and stable promoter holding indicates long-term commitment. It also means promoters have a controlling interest, which ensures strategic consistency. Governance quality is also solid. No pledging of promoter shares, which means no hidden debt risk. A professional management team handles day-to-day operations. Oversight is handled by a structured board, with independent directors across key committees like audit and nomination. The report rates the governance quality as above average, but flags one area for attention: succession planning is still evolving. Investors should watch for how leadership continuity is ensured in the coming years. In summary, Godfrey Phillips India is backed by promoters with skin in the game. No pledge, no dilution, no governance red flags, and a disciplined, cautious style of management. A rare combination of ownership stability and operational professionalism. Let's talk about the final puzzle piece before any long-term investor presses that buy button. Valuation. As of July 2025, Godfrey Phillips trades at a P/E ratio between 38 and 43 times its trailing 12-month earnings. This is far higher than its 10-year historical average of around 23-25x. In fact, more than 90% of its historical trading days had a lower valuation than today. What does that tell us? The market has clearly priced in strong future growth, high-quality earnings, and consistent capital efficiency. But here's the investor dilemma. While the business fundamentals are excellent, high valuations leave little room for error. If the company fails to meet expectations, the stock could correct, even if the long-term story remains intact. On a relative basis, GPIL trades at a premium to peers like ITC, around 22x, and VST Industries, near 17x. This premium is driven by its faster growth, better ROCE, strong promoter skin in the game, and low debt profile. But it also means the margin of safety is slim. Let's now connect all the dots. The company has delivered a 22.7% CAGR in net profits over the last 10 years. It boasts a 12x value creation ratio. Every Rs1 retained has created Rs12 in market value. Cash flows are real, debt is virtually zero, and promoter holding remains a strong 72.6%. The company is reinvesting profits into scalable verticals like exports and FMCG, without sacrificing its high-margin core cigarette business. So what's the final verdict? Despite rich valuations, Godfrey Phillips checks nearly all the boxes for a long-term compounding story: strong core business, clean financials, capital efficiency, and growth reinvestment. Investors should be aware of valuation-related risks, but can find comfort in the company's consistent execution and long-term value creation. It's not just a business with great numbers, it's a business with discipline. As disciplined investors, it's not enough to look only at strengths. We must also ask, what can go wrong? Here are the key risks and red flags as flagged by the research report for Godfrey Phillips India Ltd. Risk 1. High inventory buildup. Inventory days have increased from 94 in FY23 to 120 in FY24-FY25. While this is partially linked to retail and FMCG expansion, such a sharp rise could mean slow product movement, blocked cash flow, working capital pressure. This needs close tracking, especially in non-cigarette segments. Risk 2. Unexplained jump in other expenses. In FY25, other expenses suddenly rose to 14% of revenue, compared to the historical 5%. The company hasn't provided clarity on this increase in its annual report or investor presentation. It might reflect store expansion costs, new verticals, or a one-time legal or operational charge. But unless disclosed transparently, this remains a red flag. Risk 3. Raw material. Cost surge. Raw material costs have increased from 43-46% historically to 55-58% in FY24-FY25. Such a rise puts pressure on margins. If the company cannot pass this cost to customers, especially in price-sensitive categories like Pan Vilas and Funda Goli, it could reduce profitability. Risk 4. Low segmental clarity. The report highlights that the annual reports provide limited disclosure on revenue or profitability from FMCG, exports, and 24/7 working capital tied to each segment-level return metrics. This makes it difficult to assess which parts of the business are compounding and which are consuming cash. Risk 5. Retail venture still loss-making. Godfrey Phillips has expanded the 24/7 retail chain to 100+ outlets in Delhi NCR. While top line is growing, the segment remains EBITDA negative. The long break-even timeline could impact margins if store-level profitability doesn't improve soon. Risk 6. Valuation risk. As of July 2025, the stock trades at a PE of 38.43x, much higher than its historical average of 23x. This reflects high investor optimism, but leaves little margin of safety. Even a small earnings miss or margin contraction could cause a sharp correction, not because the business is weak, but because expectations are elevated. Forensic review. No accounting red flags. Here's the positive news. CFO to PAT ratio is 82%, real cash profits. No fake assets, no sudden reserve jumps, no promoter pledging. Contingent liabilities are disclosed and minimal from a forensic lens. The company is financially clean and conservative. Conclusion. Godfrey Phillips is a strong compounder, but like all businesses, it has pressure points. As investors, we must actively monitor inventory levels, retail turnaround timelines, cost spikes, segment profitability disclosures. Because while the books are clean, operational discipline and transparency will decide long-term compounding. As long-term investors, it's important to have a systematic checklist to evaluate a company across all key parameters. Inspired by Dr. Vijay Malik's 15-point investment framework, here's how Godfrey Phillips India Ltd performs. Let's walk through it one by one. Means a pass, means a watchlist item, means concern. Checklist evaluation. 1. Is the company growing its sales and profits consistently? Yes. Sales have grown at 11% CAGR, and net profit, PAT, at a stellar 22.7% CAGR over the last 10 years. 2. Are profit margins stable or improving? Yes. Operating margins, OPM, improved from 14% to 21%, while net margins, NPM, expanded from 7% to 19%. 3. Is the company converting profits into actual cash flow? Yes. CFO to PAT ratio is 82%, which shows high-quality earnings backed by cash. 4. Is the company reinvesting profits at high returns, ROCE? Yes. ROCE rose from 9% to 22% and ROE from 8% to 23%, indicating capital efficiency. 5. Is the company able to self-sustain growth, SSGR sales growth? Yes. FY25 SSGR is 52%, while sales CAGR is 11%, a strong margin of internal funding comfort. 6. Is the company conservatively financed? Low debt, high interest cover? Yes, FY25 debt to equity is virtually 0.00, and interest coverage ratio is 37.4x, extremely safe. 7. Is working capital managed efficiently? Watch. Inventory days increased to 120, pushing up the cash conversion cycle. Worth monitoring. 8. Is it generating free cash flow, FCF, consistently? Yes, positive FCF in 9 of 10 years except FY20. Indicates healthy surplus cash. 9. Is it rewarding shareholders via dividends or buybacks? Yes. Dividend payout has stayed around 30-33% since FY20. Predictable and consistent. 10. Is capital allocation efficient? Value creation ratio. Yes. For every RS1 retained, it created RS12 in market cap, a 12x value creation ratio. 11. Are financial statements clean? No accounting red flags? Yes, no red flags found. CFO Pat, no pledging, no sudden reserve spikes. Clean books. 12. Is promoter holding stable with no pledging? Yes, promoter stake is steady at -72.6% over 3 years, and there's no pledging. 13. Is management trustworthy and focused on execution? Yes. The company avoids equity dilution, maintains board continuity, and has strong capital discipline. 14. Is valuation reasonable compared to growth? Watch. Current PE is 38.43x, well above historical average of 23x. Valuation is rich, leaves low margin of safety. 15. Are there visible growth triggers ahead? Yes. Retail expansion, FMCG scaling, and export contracts offer multiple future growth levers. Final score. 13 out of 15 passed. Only working capital management and valuation are watchlist items, not red flags. Conclusion. Godfrey Phillips stands out as a fundamentally strong business with clean financials, consistent profit growth, excellent capital allocation, and low leverage. Despite 2 watch points, it meets nearly all quality filters, making it a strong candidate for long-term investment. Now that we've seen the complete checklist, let's move to the final investment decision. Should long-term investors consider Godfrey Phillips? To answer that, let's explore 3 future scenarios: base case, bull case, and stress case, built around expected revenue, profitability, and growth drivers. Base case scenario: sales growth, ~10% annually, operating margin, OPM, 20-21% drivers, continued strength in cigarette sales, stable performance in Panvilas and Fundagoli, gradual retail expansion. This is the most likely outcome if current trends hold. It delivers predictable compounding and sustained return on capital. Bull case, upside scenario, sales growth, 15% CAGR, OPM, 23% or higher catalysts, faster turnaround in 24/7 retail chain, rapid rural adoption of Panvilas pricing power in Marlboro and Fundagoli, efficient scaling in exports and low-cost supply chain. In this case, Godfrey Phillips becomes a multi-engine compounder, supported by internal cash, brand strength, and operating leverage. Stress case, downside scenario. Sales stagnate, and OPM drops below 18%. Risks include cost inflation not passed on to consumers, further delays in 24/7 profitability, adverse tobacco regulation, higher GST plain packaging, high inventory blocking working capital. This is a risk zone, not likely but possible if multiple pressures emerge simultaneously. Even in this case, the company's debt-free position and cash reserves offer cushion. After reviewing all angles, here's what we conclude. Godfrey Phillips is a cash-rich, high-ROCE business with a strong brand moat in cigarettes, growing FMCG verticals, and a disciplined capital allocation track record. It has delivered a 22.7% PAT CAGR, with minimal debt, stable promoter holding, and 13/15 checklist items passed. However, investors should monitor inventory levels, 24/7's profitability path, any cost pressure spillover into margins, rich valuations leaving little margin for error verdict. This is a business worth investing in, but at the right valuation and with regular tracking. For long-term investors, Godfrey Phillips offers a rare combination: strong past compounding, clean governance room to scale. The investment thesis remains intact, provided we stay alert to its few operational challenges. Before we close, here's an important note. This video is for educational and informational purposes only. We are not SEBI-registered investment advisors, and this is not a recommendation to buy or sell any securities. All data presented has been taken from publicly available sources, including the company's annual reports and investor presentations. Viewers are advised to consult their certified financial advisor before making any investment decisions. Now, if you found value in this deep dive analysis of Godfrey Phillips, don't forget to like this video. Subscribe to the channel for more insightful breakdowns and comment below. What do you think about Godfrey Phillips's future? Your support helps us continue creating transparent, research-backed content that empowers long-term investors like you. Thank you for watching. Until next time, invest wisely and stay informed.